you see on newspaper or on television news like this.
Increase interest rates.
The European Central Bank raising interest rates.
In this video, you'll learn how they work and their relationship to inflation. Interest rates are essentially the cost of borrowing money from a financial institution. When we apply for a loan, the bank determines an annual interest rate, which is the amount we will pay on top of the amount borrowed. So if you want to take out a loan, you want the interest rate to be as low as possible. But interest rates are also linked to savings, which means the higher the interest rates, the higher the returns on savings deposits, which means the banks pay us more interest on our deposits. However, the value of interest rates depends on the circumstances. There isn't just one interest rate. Each bank can set its own commercial interest rate, but they are influenced by the interest rate set by the central bank. So now you're wondering what a central bank is and what it does. Well, I'll explain. A central bank is like a bank for banks, whose function is to manage economic policy, in other words, to guarantee the stability and purchasing power of each country's currency and the financial system as a whole. Central banks like the European Central Bank or the Fed are trying to achieve a target inflation of 2%, and interest rates are one of the tools central banks use to achieve this goal. So when inflation is too high, central banks raise interest rates to try to bring inflation down. Here's how. Just like you and your savings account, banks also earn interest when they leave money at the central bank. Commercial banks like JP Morgan and Goldman Sachs have these things called reserves. Ordinary people don't have access to the interest rate on excess reserves, but it still affects them. And that's the idea. So an increase in central bank interest rates means that a commercial bank will earn more on its reserves. So it could happen that commercial banks earn more by keeping their money at the central bank than by lending it to people. To prevent this from happening, commercial banks raise their interest rates, which makes the loan more expensive. Now that you understand how central banks raise interest rates, I'll explain how they affect you. If your bank loan has a variable rate, then the interest rate you pay is linked to the central bank's interest rate. And if the central bank raises the interest rate, you pay more, so you have less money to spend on other things. So this reduces demand for goods and services, which will lead to price controls, because businesses can't charge a price that people can't afford. If they do, they won't have any customers, which will lead to the eventual bankruptcy of the business. And this will theoretically lead to inflation being controlled. But if, on the other hand, you have a mortgage with a fixed rate or simply have a house paid off, you are protected, at least from its direct effects. But indirectly, they will affect you because higher interest rates mean that mortgages will become more expensive. And if that starts to affect new buyers, then house prices will start to fall. And that will make everyone who owns a house feel poorer and therefore be able to spend less. This will translate into lower inflation. But rising interest rates don't just impact consumers, they also affect businesses. So when interest rates go up, companies will find it more expensive to borrow, so there will be products or services to develop. For example, let's say a company needs $500,000 to develop a piece of software. As borrowing is now more expensive, that company won't be able to develop its product, which will also lead to fewer jobs, and that will translate into less active economic activity. Fewer jobs and lower wages can mean less money for families, and consumer confidence can be affected, which also means less spending. So in short, when interest rates rise, we have less money available to spend. This tends to reduce spending and investment and generally slows down economic activity. And in principle, this will make companies more careful about raising prices, which will lead to inflation falling back to 2%. To sum up, a bit of inflation is good, as it keeps the economy moving, but inflation that goes on for too long is a problem. Higher prices mean that people will need a higher salary, which means more costs for companies. And this could cause prices to rise even more, which would lead to an upward spiral of inflation between wages and prices, and it's to avoid this that interest rates are raised. If you like this video, don't forget to subscribe and give it a like.